It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. Hey, we are Managing Your Financial Future. Welcome back to the podcast. Johnny Dean, podcast host, Professor Rick Plum, certified financial planner, CFP professional here. You, sir, are the advisor. I'm the podcaster. We know our roles very well, don't we?
We try to, yes. We try to stay in our own lanes.
Exactly. Now we don't have any. We don't have a guest this week, and probably not next week. I'm trying to find other advisors that would like to join us.
They have time in their schedule.
Well, that's it. Also, I haven't even asked him yet, but Joey Lucia,
president of the company.
The president of the company. I'd like to get him on.
Okay.
I'd like to get his take on certain, because Joey is also, he's a Lucia, number one, but number two, he's also an advisor. Besides being president of the company, he's also an advisor. He's also, I was going to say like hair club for men, like a client. He's not, but he's got clients, and I'd kind of like to get his take on some of the things that are going on. In fact, and that'll be at least a couple of weeks from now. But speaking of things going on, So a lot's happening here. We are going to get into this idea of diversification, the topic of diversification. How many stocks should you have in your portfolio? That's going to be the main focus of this particular podcast, this episode. But since we are recording here today, the new Social Security...
Oh, yes, those came out the other week.
That's right. The increase, the COLA, as they call it.
Cost of living allowance for Social Security. Which is based on the change of CPI from October to September, 1 year to the next.
Yep.
September is over, so October came around, and they said, well, we know the numbers. And the COLA is going to be the largest one since 1981.
Yes.
Not the largest ever, but the largest one since 1981. The COLA for Social Security recipients is 8.7%. So if you're receiving Social Security, your benefit as of January, the benefit you receive in January will increase by 8.7%. Now, if you're also receiving or paying for Medicare, your benefit will go up by more than just the 8.7%, because the Medicare premium, this is a strange thing to say about a government premium. The Medicare premium is going down by a little over $5.
Has that ever happened?
I not in my recollection, but I haven't really researched it that far back. But the last increase we had from 21 to 22 was a pretty substantial. It was, $20. It went from like 155 to 170 or something.
Wow, is it that high? I haven't looked at it.
Yeah, it was 170, so it's going down to 164 and change now.
That's what most people are paying.
That's if you're not in the IRMA category,
right,
income related monthly adjustment amount. But yeah, so you can experience a little bit more pay to help combat some of this inflation that we've been,
So it's going to go from, say, 170-ish down. Does it go down a lot?
The premium for Medicare goes down $5.
So $5. All right. So
$5 and change.
Well,
not
sure.
exactly
Okay.
$5.
But if you had
and that's Medicare Part B. If you have Medicare Part D, depending upon the plan, because in Medicare Part D, that's the prescription drugs. They have multiple regions, multiple different plans you can have. Many of them are also going down a couple of bucks. Some of them are not going down.
Okay. All right. That's the supplemental. Yeah.
Well, it's not a supplemental plan. There's Medicare. The supplements are outside of the basic Medicare AB. Medicare Part C is what's known as Medicare Advantage.
Yes.
And then
which we don't talk about a whole lot.
It works and it doesn't work for some people. So it's one of those things that it's a great thing for a lot of people. But basically you're still paying the Medicare Part B premium for the Medicare C. It's a Medicare Advantage. But
yeah, so what often happens is people take their Social Security payments, and then part of those payments get cut down by the amount of the
if you're receiving
Medicare premium.
If you're receiving a Social Security benefit and you're on Medicare, they're going to deduct it from your payment, from your benefit. So you don't even see the whole benefit most of the time.
No, but if you're but an 8.7% increase,
right,
I mean, if you get a $2,000 benefit
like
this year,
that's
going to be about 100. So you're going to go up to about 2170, 2175, something like that.
Nice little increase. Then another $5 you get to keep in your pocket because of the Medicare decrease.
That's true. So anyway, it's a good thing. I don't have any planning suggestions for people on this.
Yeah, save that whole amount. But I remember when it first showed up, I saw that the CPI over the CPIU, which is the more broadly based one, over that same period was up 8.2%. But Medicare got the 8.7% increase because it's based on a kind of a subset, the CPIW, of which is a smaller representation.
It's a modified version of that.
And so we'll take it this time.
Yeah. Anything is good. And the good thing is, it sets the bar higher because, benefits next year, depending on where they find inflation and all that stuff. I mean, everybody's benefit, your benefit and my benefit is now higher, even though we haven't started taking it yet.
It's interesting. Your benefit, my benefit. We have not started taking our benefits yet. And so people will ask, if I'm delaying taking my Social Security, do I also get an 8.7% increase if I'm delaying my benefit?
Yeah.
And the answer is not exactly, because your benefit is still going to be calculated based on the formula. And the formula is based on some numbers, underlying numbers.
Yes.
Those numbers. So what they do is they average out all your earnings, and then they apply a formula, and you get 90% of the first tier, 32% of the second tier, and 15% of that above. That where the tiers end, they call them bend points in the formula.
Yes.
Those bend points go up with inflation.
Yes.
But not CPIW. It goes up with a different inflation factor. And so some years you get a bigger increase in the formula calculation than you do on the COLA. And some years the COLA is bigger than the benefit calculation formula.
Okay, so this year
it all averages out. I haven't seen the new bend points yet.
Okay, I suspect though. I suspect they're going to be higher than they'll be raised more than normal.
Well, they're being raised. Consider normal over the last 20, 30 years has been almost nothing.
Right, exactly. That's why I'm thinking, especially with the amount of with the high numbers on the CPI, CPIU, and all that.
And this is a good thing for people receiving it, but for those that are worried about the Social Security Trust Fund going broke, it's just going to go broke that much quicker because they're paying out more.
Let it go broke.
I'm just teasing you, John.
You always trigger me with that. What's going to happen when it goes to zero? Nothing. They'll still pay. It makes no difference. All right. Anyway, wanted to get that out of the way for you folks who are
we're wondering.
Well, I mean, people, by the time they're listening to this podcast, they've probably already heard that the benefits were going to go up. But they may not have known that the Medicare. Oh, when does this happen? By the way, when does the benefit? When will people start paying less for their Medicare?
It's
benefit?
a good question. I had somebody who started taking their Social Security in August. And they're saying, well, do I wait 12 months and then on my anniversary of starting, do I then see the COLA? No, everybody gets the COLA on their January benefit. So
starting
January. So whether you started in this month, whether you started 10 years ago, whether you started any other time, the benefit increases in January.
So would it ever behoove somebody who was going to wait till January to start taking their benefit? Would it behoove them perhaps to start taking benefit now so they can take advantage of an 8.7% increase?
Depends on what those bend points come out to be in the formula.
And we won't know that until when?
Probably this week sometime.
Wow, interesting. I'm going to have to talk about that. That may be a strategy some people.
And the difference at that point will probably be $1 or $2. They're usually fairly close. But
yes.
One may go up. I remember looking at one. It was one increased 2.5% on the COLA 1 year, and the bend points went up 2.9.
Well, yeah, and that's why I was saying I suspect that for people who are the formula for the bend points, I suspect that they will be up substantially as well.
They're going to be up substantially. Will it create an 8.7% higher benefit? We'll see.
I don't know.
It'll be close.
I don't know. But that's what happens, when interest rates go up and things like that. We're going to talk more about interest rates.
This isn't based on interest rates per se. It's based on inflation.
No, I know. But when you have inflation,
which
you
generally
often
leads
to higher interest rates. I'm not saying it's a cause, but this is what happens. And we're going to talk more about bonds next week. But, we mentioned a week or two ago about this sort of double whammy that we got. As bonds started to go down in value because interest rates went up.
Well, as interest rates went up, bond values went down.
Right.
And unfortunately, about the same time, stocks were going down as well. So the idea of a balanced portfolio where one side was buoying, whatever.
Holding it up,
holding up the
keeping it afloat, whatever.
Didn't happen this year. And it's not very often that we see, bond rates or bond values, bond pricing, and stock values go down at the same time.
So one of the oldest adages of it's not an adage, but one of the oldest things that people do for their stock portfolio to try to mitigate the risk is to diversify. You used to hear this all the time.
And diversification is very important because like if I had all of my money in and I had to pick one security, Murphy's Law says I'm going to pick the wrong security.
Right.
So if instead of picking one, I can pick 10, 12, 15, 20, I have a much better chance of not picking the worst security in the world. And so I have a better chance of, basically diversification is spreading the risk. The whole idea of diversification is if I were to, as a betting man, or if I was a betting man, putting all of it on one thing, if that number came up, like if you're playing roulette, you put it on one number, that number comes up, you make a lot of money.
Sure.
But there's a lot of risk to that.
Yes, of course.
So the idea is to spread the risk around.
In other words, put your money on
multiple numbers. I don't know how to play roulette, so I'm just.
I don't either, but I know where you're going with this.
So you spread it around, and so how diversification helps you not pick as many losers, and you have more chances of getting a winner. But you also you can't have all your money in the one. I mean, if we really knew what was going to happen, there's a couple of stocks over the last 5 years that we would have put 100% of our money into. We wouldn't have bothered with an index. We wouldn't have bothered with any other stocks. We would have just bought those securities.
Right.
Like back in the 1990s, you would have bought about 5 different stocks up until the end of 1999, and you would have, they just did great. But if you bought a big diversified portfolio, it watered down your return. So diversification works on both sides. It waters down your risk, or it spreads out your risk, but it can also potentially water down your return. So there is something that we've been finding, and studies have been bearing out, that a lot of people now, and a lot of money managers, specifically mutual fund managers, they're over-diversified. They're buying too many things. And the reality is that if you're a mutual fund manager or a money manager, your best guess, you have high conviction on maybe the first 10 or 15 stocks that you buy. And then after that, you've got so much money, you just have to keep buying other stocks. And you don't have as much conviction when these other, the 400th stock you put into the portfolio as you did with those first 15 that you thought were going to do well. And so there is an idea that over-diversification is now hampering a lot of individuals' returns. And unfortunately, most individuals are using mutual funds, which have the most over-diversification out there. A pure index, unless you're using a very condensed index that's been already brought down to a concise number of stocks. If you look at the S&P 500, let's ignore 2022 where everything is down, or pretty much.
Right.
But even in 2021, when the index was up, like 28% or some number like that, less than half of the stocks in the index were positive for the year.
Yeah. So
if you could have looked at the index and said, of these 500, these industries are not going to do well in today's world. Let's pare back on those or get rid of those altogether. Or let's move away from the companies that don't have, the balance sheets that look like they're in trouble. Let's get away from the dogs.
Well, the ones that obviously you don't know what's going to happen in the future, but you would look at certain stocks that seem to be obviously not going anywhere, and you would eliminate those.
There are industries that are mature, but they're still big companies that you don't expect them to grow through the roof. And so by making a less diversified portfolio, I'm not saying not be diversified. You still want to have different industry representation, but do you want to have every stock in that industry? You still want to have across the board, different sizes, large company, small company. Who's doing better right now, value or growth? Well, what month is it? It depends. Who's doing better, large or small? Again,
well, that's it. See,
domestic or international? Well, that was easy. International has trailed domestic for a while lately.
Well, it's not, you're right. It's not just having different stocks, but different asset classes, diversification among different asset classes. Maybe a percentage,
But the goal of diversification is to spread the risk. But in spreading the risk, you could spread it too far.
Well, I read a good quote from Warren Buffett. I assume this is true. He said, "Wide diversification is only required when investors do not understand what they are doing." In other words, if you diversify too much, you might not lose as much, but you won't gain much either. Your roulette wheel example, I think, shows this, because if I want to go play roulette, I could bet on every single number. I don't think you can bet on the 00. I think the house gives themselves that edge.
But the house has got some edge.
Right. And I don't know roulette either. I've never played, but I've seen it. You could bet on all, is it 36 numbers?
And you're going to get less of a return because only one of those numbers are going to hit.
Right. So if I put $36 down, and what am I going to do? I'm going to win, 1?
Yeah, I don't know how it works, but
Well, 36 times 1. But yes, I'm going to almost break even.
when I started in this industry back in the 80s, I remember speaking or listening to a money manager, and this was a money manager to the rich and famous. And his idea was, if you are going to be investing in stocks, specifically your own specific portfolio, you want to have at least 3 or 4% of your portfolio in that stock. So, but you never want to have more than maybe 10 or 12% in that one stock, because you don't want to risk it to where you lose. If you put 50, if you only have 2 stocks and one of them goes down, you lose 50% of your portfolio, or a big chunk.
Yeah.
But on the other side, if you really believe, if you're willing to put your money into a specific stock, have some skin in the game. If you only put 1% of your portfolio in this one stock, even if it doubles, what did it get you? It got you a 1% return on your overall portfolio.
Right.
So either you believe in it or you don't believe in it. This goes back to what they were saying about, a money manager has great conviction on maybe 10 or 15 stocks, but then after that, it tails off a little bit. So when you're talking about managing money, you may want to move away a little bit from the super diverse, the mutual funds that have 4 million stocks in them. I mean, and a lot of people say, well, I don't know how many stocks. You can go to Morningstar, you can go to different places, and it'll tell you how many holdings they have. It'll tell you how many holdings are in the top 10%. That's a big issue too, because is it condensed? You may have 300-400 holdings in a mutual fund, but 30% of the portfolio is in 3 stocks. Meaning they take up the majority of the portfolio. So as those 3 stocks go, your portfolio is going to go.
Yeah, we've seen that a lot.
And this is just information that if you're trying to do this on your own, you kind of need to know it.
Well, and how many people do know this? The question becomes then, well, I mean, is there an optimal number, potentially, of stocks that you should own in your portfolio? I mean, I've seen people, as you said, they got 200-300 stocks. They've invested in these mutual funds or balanced funds that seem to run all the way across the entire market, and they are not seeing the types of rates of return.
Well, and I also think that's why ETFs are becoming more popular over mutual funds.
ETFs are exchange-traded funds.
Right, and they trade on the market, and they can be more condensed. They can be more concise, and so you can have more sector-oriented areas rather than just having the 100% broad market. And be a little bit more selective, and you can manage it a little bit more. So you're with an exchange traded fund, you can have some diversification because it has more than one stock in it, and you can get an energy ETF, you can get a biotech ETF, a pharmaceutical ETF. But instead of having to pick the one stock that makes it in that industry, you've got multiple stocks in there. Now, obviously, if you knew which one and you were lucky enough to pick the one, you're working for and against your own best interest. You're diversifying your chance of hitting the right one, but you're also diversifying your chance against hitting the wrong one. And so you're reducing your risk, but you're also watering down your return potentially if you could have picked that one that did really well. But ETFs have become more popular. They're a little easier to tax manage. You don't have to worry about big capital gain distributions at the end of the year like we might be looking at this year. We're coming into another week or two. We're going to start the beginning of the capital gain distribution declaration period.
Through the end of the year, pretty much, or at least through November.
And people will say, well, wait a minute. My portfolio has lost money this year.
Yeah.
Why would I get a capital gain distribution?
Just like we talked about a couple of weeks ago.
We've talked about it before. Mutual funds have had to redeem a lot of shares with people selling out. And in doing so, they've had to raise cash from internally. Where'd they get that cash? They had to sell assets, some of which they've owned for a while and had gains. Those gains could be distributed. So I was talking with our money manager the other day. We were talking about mutual fund portfolios and trying to get a list of the capital gain distributions before they're declared. Because if I have a loss in that portfolio, I'd rather sell it at a loss, buy a similar fund than maintain that fund and get a capital gain distribution where I have to pay taxes.
Now,
and a down year.
Now you're going to reset your basis a little bit when that happens.
But I'm also locking in a loss that I can use against future gains.
Yes, you can. And with mutual funds, is not a wash sale, right?
No, as long as I don't buy the same mutual fund.
Well, no, that's what I mean. You can buy a similar mutual fund.
Yeah.
All right.
The old wash sale. Okay. Bring that one up. Okay, thanks. But diversification is important.
Sure.
But we're learning that a lot of people and a lot of advisors are dealing with an occurrence of over diversification.
So
there's just too many.
Is there an optimal number of stocks you should own in retirement?
I don't know.
I have read a number, and I'll anywhere between 15 and 20.
I have read multiple numbers, and that's, each person. But yeah, if a portfolio, like we manage different portfolios, some have 12 to 15, some have 20 to 30.
Okay.
But there are certain disciplines. And so that's what we're looking for doing.
I've seen charts that sort of show this declining. Well,
efficiency?
Yeah, is really what it is.
Marginal efficiency? Yeah.
Yes. How much risk are you reducing? I mean, you're reducing quite a bit of risk from going, between 1 and 5 stocks to 5 and 10.
To get rid of the majority of the risk, but you don't want to diversify so far that you get rid of the majority of the return too.
Well, and that's exactly what it is. And so they've tried to come up with some kind of number. Now, people might say, well, wait a minute, 15, 20, 25 stocks, that sounds kind of like dangerous because, don't I need at least 100 to be well diversified so that I don't...
Are you diversified?
Well, yeah, that goes back. That of course goes back to the tech bubble. Remember that? Yes, I own both. This tech company and I own that tech company.
Right, and diversification is important. And like I said, and I think the number actually varies based on where you're investing and how you're investing and who you are. I don't think there is a one-size-fits-all number for everybody.
No, but would you say that 100 stocks to own, say, in retirement or at any time, let's just say any time in your portfolio, is that...
I think it's excessive.
Yeah.
Now...
Maybe not in every case.
Yeah, I think that's an excessive. But the problem is, if you buy one mutual fund, you probably have more than 100 stocks.
Oh, sure.
So how do you get around it, especially when you have your 401k where the majority of your money is, and the only options you have are mutual funds.
So let's talk about then when you guys, the Lucia Capital Group, we're going to talk about putting together a bucket 3 for somebody.
Right. And it depends on size too, because it's very difficult to manage an individual stock portfolio with $10,000 when some of the stocks that are out there are $1,000 a pop.
Well, sure. Let's just say the average person or whatever.
Yeah.
When they do this, they are not putting together a bucket 3 portfolio, I would assume. I can't guess for everybody, but of 100 stocks. Is it closer to the,
closer
15, 20,
30
25?
to 50 at the most. We're looking at, depending upon how big the portfolio is, anywhere from 15 to 50 for the majority of people. And then if we want to put a small cap sleeve in, there might be another 30 there.
Now, okay, so but the people, they have to have some confidence in those stocks.
Right. So we have people that basically spend their days evaluating the economy, evaluating the balance sheets, evaluating what's happening, trying to anticipate what's going on. Luckily, Chairman Powell has said, I am going to raise rates. And so he's been pretty true to his word. So we have a pretty good indication of what's going on from that side of the economy. So
right.
Other things obviously can be blindsided, but yeah, they're looking to put together their best. Now, there's different disciplines. You can have a growth investor, you can have a value investor, you can have a global nature where you're looking at either U.S. and international stocks, or you could look at U.S. stocks that are global by nature. Or,
yes.
And so, or you could be looking at small and mid caps, because small and mid caps have a different flavor and a different risk parameter than the other stocks I just mentioned. Yeah. So you want to have a little bit of those different areas, but you're probably going to have 10 to 15 in each of those areas.
Yeah. Now, if you're going to have that number of stocks, I would assume that it would behoove the investor to know something about each one of those companies. As we said, you got to have some professional people that are looking at this stuff, because
it's tough for an individual to do this.
Very tough to do.
Because that's a lot of research. That is, I know some people that do it, and that's their life. And it's what they love to do. And they do it for themselves pretty much only. I remember going into one gentleman's house, and he had 5 or 6 different monitors at the time.
Yeah.
And they were on different stock markets, and that was his life. He watched those all day and different times. He got up real early because of the different international markets and watched them, and that was his life. He had loved it. And the problem was he didn't do any better than just an average investor.
Well,
because he was being emotional too.
Well, that's the other part of it. We're going to leave the emotion out of it. Well, actually, we shouldn't leave the emotion out of it.
It's an
because
issue.
when I talk about somebody who's got, they hire a money manager, somebody who understands how these stocks and does all the research and loves it. I mean, that's something that you're taking the emotion out of it,
right.
At least for yourself.
And I remember I was with somebody. We were looking at a portfolio. And there was it was like 12 stocks, and there was a particular stock in it. And the guy was looking at it and saying, why'd they buy that?
Yeah.
I would never have bought that. So we called the manager, and the manager said, went through each stock and why they owned it. And he said, well, why'd you buy them? He goes, that one is because if all of these don't work, that one will. It was more of a defense. It was the way he put the portfolio together to do a little bit of risk management in it. He goes, I do believe in the stock. I don't think it's going to do 30, 40, 50% like some of these others might. But if these types of environments happen, which are not expected, the majority of the time, but could happen, and so they were not just looking at putting stocks together that are going to react the same way for all news going forward. They were looking at putting together a portfolio that could react positively for different kinds of news.
Do people who do these things for a living generally do they often have access to information that most of us do not? Because if we're all going to sit here and research companies and do our online research, aren't we all looking at the same information or not?
Yes and no. I mean, most likely, there are a lot of paid services that these people pay to have information from that we would normally not get, but it's probably information that anybody could pay to get. But it's also, do you know where to look for it?
Yeah.
And how many sources do you have time to look at? How many people do you have on your staff for your portfolio working for you, researching and doing things? And so, yeah, there is some areas where it's more difficult to find information. The more the manager is known, the more the information they can get from not inside sources, but from closer sources. I won't say it's insider, but they can get a feel for talking. They can call people at the companies to get a feel for what's going on, that those people would not pick up the phone for you and me. We can't call those people.
Yes.
And so a good manager will be able to have insights that maybe we don't have, because they have access to information that's public information, but maybe not readily.
You got to be able to
available.
find it.
You got to be able to
it's
find
out
it.
there, but you got to know where to look.
And they know where to find it.
I've talked to. If I could convince one of those stock people, we have a couple of people. We have a couple of people on our staff, on our team, and as you said, that's all they do. This is they work on the investment side of the company, and this is what they do. If I could ever convince one of them to come on and talk about it, they're too microphone shy. But if I could, I would love to get some insight into how they pick this stuff.
Well, also the language they use. While it's English, it's not the English that we use all the day.
Well, I think one time we did have one of them on our TV show. This is 4 or 5 years ago, and man, it got so technical and detailed that we had to keep stopping down to explain what the person was talking about.
But it was interesting.
Well, it was interesting.
Great information. It was just hard to follow, because they're working at a different level. It's kind of like, when I start talking about taxation, I was talking to somebody about setting up a portfolio and blending the income between IRA and non-IRA and the implications of a taxation, and watching it ramp up really quickly because Social Security is all of a sudden becoming taxable. And I watched this person's eyes just glaze over, because they didn't know the interaction between Social Security taxation and distributions from IRAs and other accounts. It's like, really? Huh?
They should listen to us once in a while.
Yeah.
We have a couple of webinars on that. Is the amount of stocks, and we talk about the amount of stocks somebody should own, is it different for somebody who's in retirement versus somebody who's not in retirement? Should somebody who's still growing their portfolio...
I think you're going to have a different number of securities, because you're going to have a broader based portfolio.
Different number of securities.
A 25-year-old that has some money, they're going to have 10 or 15 stocks. A 65-year-old, for their portfolio, is not only have those 15, they're going to have they should have a bigger portfolio, but they're also going to have some other securities. They're going to may have some individual bonds and some other things. So they're going to broaden their spectrum of what they're actually investing in. They're going to have maybe some alternative type investments, some real estate, some private debt, and some other things that person that's only invested for pure growth won't have. And so it's a different game when you get out that far.
So when you're speaking strictly of stocks,
they do. The older individual will probably have a bigger diversification, because that's what they've been taught all their life. And that's what they're comfortable with. Whereas I don't think that if I have somebody who has $300,000 and they have identified that $300,000 purely for growth, if I don't care what age they are, I'm good with that 15 to 20 stock portfolio for the growth portion of the portfolio. Obviously, the 65-year-old may have other portions of the portfolio, but that 75-year-old may not be comfortable with only that. Now, other times they're totally comfortable with it being their only growth portfolio.
I find that interesting because if they are trying to if they're trying to diversify and I want to say potentially saften up their portfolio by diversifying even further.
You don't saften up by diversifying into more growth stocks. You saften up your portfolio by buying CDs, individual bonds and things of that nature, so you guarantee your cash flow.
Well, sure, yes, and just very quickly because we're running out of time.
You bucketize.
Again. If you're bucketized, I mean, wouldn't you want to kind of dial up your bucket 3 for some kind of growth, or is that because you've got 15 years or so?
That's why I am comfortable
to have just maybe 15, 20
to 20, 30 stock portfolio. But like I said, though, some of the retirees are not that comfortable with it because they've been,
maybe they don't have some kind of bucket strategy.
Well, no, even with a bucket strategy, because they have grown up for the past 30 years.
So they don't want to see
with the idea of diversification. I need more diversification. Okay. And that's what, it's hard to change your thought process overnight.
Well, I was hoping to do that with this podcast episode here to talk about diversification because I think, as you said, Professor Plum, I know it's not a consensus, but there are a lot of people out there who really believe that the more diversified you are, the better off you are.
Right, but at some point, you're losing efficiency. You're being too diversified.
You're putting too many chips on the roulette table.
You're watering down any chance of a return, any chance of even beating the market, so to speak.
Yes, and I would contend, as I just did, that if you've got a bucket strategy that's been properly put together,
you've identified what is growth, and you've identified what should not be invested for growth.
Yes, and you've got time for all the stuff to take place.
For your growth, you've got time.
Yeah, so I would suggest that if you're properly bucketized, you can potentially get away with that. If you want some more information on this stuff, we're going to post a few things at luciacap.com, luciacap.com. I mentioned that the folks at Lucia Capital Group also they've got an entire investment team working behind the scenes. As we said, that's all they do. They have nothing to do with the planning process. Do they, Professor Plum? I don't think the folks in the investment side have anything to do with the planning part. That's all you guys, right?
No, but we do talk about it. We do talk about the expectations of the buckets, what we're trying to achieve with the buckets, what kind of risk we can or cannot accept within the different buckets. And so they do create portfolios, maybe not for the bucket 3 pure growth portfolio, but for the shorter term portfolios. They're dealing with how much risk is acceptable or not acceptable, liquidity issues. And so they are talking to us about those types of things to make sure that the investments that are being used fit the parameters of the identification of what the necessary need is.
If you want more information, you can give them a call at 800-644-1150. Talk to the folks at Lucia Capital Group and talk about your strategy. I mean, it does come down to the bucket strategy. It comes down to things like diversification. But what's really important is that you've got a plan, something that identifies your goals, and that's exactly what they do. 800-644-1150, or as I said, luciacap.com, luciacap.com. Out of time. Next week, I want to talk a little bit about interest rates. I know that it's been an interesting ride this year as far as interest rates go. I don't know. I suspect they're not done raising interest rates, although, I mean, it's been quite a shock to the system so far.
They've said they're not.
They've said they're not, and maybe it's all being priced into the markets now. I honestly don't know. But I'd like to talk next week about bonds, not specific bonds, but I want to talk about why someone might own bonds. We did this a couple of years ago when interest rates were low. Now that interest rates have come up and are potentially going up more, is it still risky to own bonds? Is it riskier to own bonds? We'll talk about that next time. Out of time. For Professor Rick Plum, CFP professional, certified financial planner, I'm your podcast host, Johnny Dean. Thanks so much for listening. Managing your financial future. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material contains tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. Investment products described herein may not be offered for sale in any state or jurisdiction in which such an offer, solicitation, or sale would be unlawful or prohibited by the specific offering documentation. Diversification strategies do not ensure a profit and cannot protect against losses in a declining market. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk. Bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider a mutual fund or an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial. Morningstar and Warren Buffett are not affiliated with Lucia Capital Group or LPL Financial.